So in front of me here, we have a chart of A2 Milk. A2 Milk is a stock that's been kind of uptrending for a long period of time. And I just want to explain the trader's theory versus an investor's theory. So here, as you can see, the stock's in a long-term uptrend and investors would have bought about here and they would have been loading up their position a bit more up here on the way higher. So what's happened is here we can see that it's had a big dip due to earnings. So the earnings wasn't taken well by investors and we just saw a downtrend of price. After the price has downtrended for quite a number of days, it looked like it started to round out, but actually this was a bull trap, because when a stock is in a downtrend and has a small uptrend short term, then this usually means that the dumb investors or the amateur investors and the amateur traders usually come into the stock expecting a reversal. And then what happened there was we had some more downside, and so there was some panic selling because people buying and these investors now can't hold on to their position any longer. And then you saw kind of like another bull trap where people were like, okay, finally that the stock's starting to lose momentum and it's going to start uptrending again. So again, you can see that it's kind of gone down slightly again. And so you don't really actually know when a stock is going to reverse. The only way you know that a proper reversal is happening is that if it has a series of high lows and high highs. On another side, if we were traders, then we're probably looking for sort of a breakout above that point, because you can see that it's had multiple taps of resistance up here. And here it's actually looked like it's kind of broken out slightly. So I actually took a trade around here because I thought it was going to break out, which it did, but then the next day it continued lower, and then I was kind of stopped out around here. The benefit is that I knew straight away that I was wrong. I was able to get out of my trade, I took a small loss, and I was able to look for more trades. So I had my capital open, and this is good because if you have your capital available to you, then you can be looking at other sort of stocks to invest in. However, if you stuck your whole, let's say 5 or 10 grand into this stock here, all of a sudden it's gone down, you never cut your losses, and now you're kind of holding and you're down about 20%. And then you're not going to sell because you're going to hope that one day it will kind of return back to this previous highs, and then you'll probably look to get out of break even or a little bit higher than that. And that's just kind of like the average sort of investor theory. So this is the benefits of trading versus the benefits of investing. If you're a trader, you're kind of getting into stocks quick, you're getting out quick if you're wrong. If you're an investor, then you're kind of holding on long term and you don't really worry about the ups and downs that happen in between. But me personally, I think that's a huge opportunity cost because you could be using that capital to invest elsewhere.